Okay, so now I have to share the screen, I hope. Oh, your entire screen, is that what I do?
You can do, or you can do tab.
How do I find what's on my desktop?
It should show on your what you're looking at. So you could do tab or window. It gives you like 3 different options.
Yeah, but the slides are open on my desktop, so how do I get to that? Which one do I pick? Do you know?
No, can you just
okay.
try one
Okay.
and see if that works? Sorry.
No, it won't let me share at all. No. Oh, maybe it will now. Okay, let's try. Oh, I see. You have to click on it like that. Okay.
Yeah, click on it and then share. Oh, right. So we can see your desktop. We can see your AirMate. Hello, everyone. Sorry, we'll get this sorted in a second.
What do I do now? Sorry.
You need to share a different tab if possible.
And any idea how I do that?
Right. So stop sharing.
Stop sharing.
So at the bottom.
Okay. Yeah.
And then it will give you, hold on, let me just try and share my screen. So it will say your entire screen, application window, or Chrome tab.
Okay. Right. And which one do I pick then?
Whatever one, I won't be able to tell you because you need to see what one your PowerPoints are on.
Well, the slides are on my desktop, so I don't know what that means.
So can you do your entire screen? So if you
That's what I did before, yeah.
Right, can you go to application window and then just try one of them? Hayley, do you know the answer to this?
I'd say share desktop and then minimise the presentation.
Gosh.
Yeah, just minimise that window.
Okay. Right. Okay. Can you see anything now? I can see the slides, but
no, we can't. No. Can you? Okay. Sorry, everyone. If everyone's all right to wait, can you email them to me, Kate, and then I can share my screen and talk you through it?
I did this morning.
Okay.
First thing. I can send them again if you bear with me, but it'll take me a while to open up Outlook and everything.
Let me have a look. The joys of modern technology, hey? Can you do us a favour? Could you just send them to myself again, please? Sorry.
Yeah, I've got to even work out how to open Outlook without dropping everything out.
Or if not, can you talk? Do you need the slides to show?
Yeah, I can talk over them if I look at them here, but it's whether really then don't make so much sense if I'm just talking.
Yeah.
So the slides would be good if we can.
Hold on, let me just see if I can find them. Do you know what time you sent them?
Early, about 6:30ish, maybe.
Yeah, I've got an email at 6:32, but the slides aren't on there.
Okay. Right, let's see if we can find them again then.
Can everyone actually hear us okay as well while we're just waiting? Yeah, great. Okay, cool. Is everyone all right to hold on and we could just get the slides up? Sorry for the delay. The joys of having new technology. Thanks, Vicky. Sorry, Kate. It's just to stress you out a little bit.
It's all right. It's just taking a little while to open everything up and find all the slides to attach.
Can you send them to Hayley as well? When you send them?
I'm sending them now.
Thank you. you want to do an introduction while we're waiting for these to come through? For those of you that don't know you.
Yeah, let me just try and shut Outlook down again, because it will just make a noise in the background otherwise.
Don't worry, we're not going to be questioning about that, Kate.
Right, so I need to potentially turn that on, I think. Is that right? Yeah?
Yeah, we can see you.
Okay.
I can hide myself.
Okay. For those of you who haven't met me before, I'm a very ancient payroll consultant who clearly doesn't know anything about technology, I'm afraid. So I do apologise that you I couldn't get the slides up immediately. So hopefully Mel and Hayley will be able to deliver that for you. I am a payroll consultant who predominantly, only does UK matters. So I'm not at all as clever as you guys who manage all those countries. But in terms of the UK, I look after 7 of the apprentices that have started with the GPA in the first cohort. Also, member of the ICAW Employment Tax Committee, where I'm the vice chair of that. And the rest of the time, I spend my time looking after clients of all shapes and sizes from a payroll perspective, both on an ongoing basis in terms of consultancy for them, but also doing lots of training, not face-to-face, of course, at all anymore, and lots of writing for clients as well, like expert HR and people like that. So yeah, a whole range of different types of areas, but only on the UK, not at all involved in anything broader than that. So yeah, that's me. I am, until the end of this month, also responsible for a few little payrolls that I look after just on a voluntary basis to keep my hand in, but they're going at the end of this month because I've only got a year left to go before I retire. So it's time to hand over those sorts of things to people who are coming on who are much younger than me and will be the future of the payroll profession. The other thing I've obviously been involved in a lot over the last year is all the furlough situation, because at ICAW we worked with the Treasury and the Revenue on developing the guidance and generally trying to help them understand practical matters. So never really wanted to be a furlough expert as well, but that's kind of how it's worked out over the last year. Okay, thank you very much for managing to do that, guys. I'll probably have to ask you to move the slides on, won't I? I guess, as you've got control now. Is that right? If I just tell you when we need to move on? Yeah, is that what I need to do, Hayley? If I just shout whenever I need the slides to move on?
Yes, please,
Okay.
Kate.
Lovely. Okay. So where we are in the UK at the moment is a bit of an unusual situation, to put it mildly. I'm not referring to lockdown, I'm talking politically, because we had a very, very late budget last week, which would have caused us trouble if we hadn't spent a lot of time as both the software bodies and the accountancy bodies lobbying HMRC and the Treasury to try and extract the information that we needed in order to be able to pay people from the start of the tax year on the 6th of April here in the UK. It would have been too late last week on the 3rd of March for that information to be made public, because there will be payrolls for month 1 that is already run by the 3rd of March, particularly, for example, at my old employer, which is a large UK retailer. We would have run April payroll last Tuesday, so it would have been far too late. So we did manage to successfully get that message over to government. But we're in an in-between situation, because we were told the week before the budget as well that there would be a second tranche of announcements on the 23rd of March, which is what we call in the UK Legislation Day. At the moment, we're just being told there's a tax-related announcements in terms of the name of the consultation paper that's been published, but whether that's got any information around other topics such as national insurance or social security, if you're looking at it from a global perspective, we're not sure entirely what might happen on the 23rd of March. But in the meantime, let me talk you through what else is happening. So if we can have the next slide, please. The most, I suppose, successful amount of lobbying that we managed to achieve was to stop the Chancellor not uplifting the personal allowance of tax-free pay in the UK, which was potentially what was going to happen last week. And we had conversations to encourage Treasury Minister Jessie Norman not to have that happen, because logistically all of the tax codes had already been issued by HMRC, and we also had all our software with authority, which is called a P9X in the UK, to uplift all the personal allowances. To undo all that would have meant it couldn't have happened on the 6th of April, and it would have had to have been done retrospectively, which would have been very messy. So it was a relief that they listened to that and kept the personal allowance uplift from April, which has gone up to 12,570. It's only a £70 increase, and it doesn't sound a lot, but overall it would have been very difficult to unwind it. That's why it's going to be frozen for a 5-year window, because the government was obviously predicating its budget forecasts on not having to give that £70 per person, so the freezing has had to go on longer to allow for that. But that leaves us with the tax codes that we expected at 1257L, and some very small coding adjustments to all the people with the standard suffixes of L, M and N. It's meant we haven't had any change to the income threshold, which is the point at which, if your total income in the UK exceeds a value of 100,000, you start to lose your tax-free personal allowance, and that goes completely this year. That's starting at £125,140. If we can have the next one, please. So we've ended up that the tax rates and bans in the 3 countries that we call rest of UK have ended up remaining as had originally been expected, based on inflation-based increases. It's also meant, though, that the increase at the end of the 20% tax band, which is to take it slightly higher than it has been for recent years to 50,270, that's also going to go ahead, but it's frozen again for that 5-year window. Within those tax bands, 10% of the tax in each band goes to the Welsh Assembly. We have tax sharing powers with Wales, so whilst it's not devolution in its full sense, there is a sharing of some of that tax with the Welsh Assembly. So next one, please. If we think about what has happened in Scotland, Scotland has had their tax raising powers for a number of years now. They have a very different structure of 5 rates and bands. The rates have stayed the same for April 21, and the bands have changed slightly. It's a low income economy in Scotland, so it's predicated on more support at the lower income end than in the rest of the UK. So you save about £20 at the lowest earnings thresholds, and it's about £1,500 a year more expensive to be a Scottish taxpayer once you take Social Security into account as well. Next one, please. If we look at national insurance or Social Security in the UK at the moment, unless something is going to be announced in March, there's no changes to the percentages for both employees, which you can see on the screen, and next slide please, or to employers either. So we still have 13.8% as the headline rate. There is a change to employers NI this year, but how many employers will take advantage of this is a bit of an unknown. There was a manifesto commitment when the Prime Minister was elected to support those who are coming into civilian employment from the armed forces for their first 12 months of employment by incentivising employers not to have to pay a certain amount of national insurance on their behalf. So that's taking effect in April, and it's a 3-year exemption that's projected at the moment. It actually doesn't mean anything in payroll software as it stands, because it's not going to be an automated exemption. So employers who take on ex-armed forces veterans will have to pay the full national insurance and then make a reclaim of what they've paid after the end of the tax year, and we don't know what the mechanism for that will be at this point in time. Next one, please. But these are the thresholds that we have for national insurance. So again, we've got a freezing here because the 3 top level thresholds, the upper earnings limit, the apprentice threshold and the under 21s, because they're aligned to the end of the 40% band, those also end up being frozen for a 5-year window at 50,270. But at the 3 lower thresholds, that's the lower earnings limit, the primary threshold and the secondary threshold, which is where you start paying Social Security in the UK. Those are the ones that we're not quite sure what the government will do going forward, because they've made no commitment about them. So in order to do even the freezing of the top 3 thresholds, there will need to be legislative change because they go up by inflation each year. So they could decide to do the same thing with the lower thresholds. They're much more politically sensitive, of course, because they impact lower earners and entitlements much more significantly than the higher earners. So it's really watch this space about what the future looks like. In terms of things that are allied to social security, the apprenticeship levy in the UK, well, in England I should say, in terms of it coming back to employers, but the whole of the UK you pay still at 0.5% with the levy allowance still at 15,000, so that hasn't changed year on year. Next one please. Changes around pensions, well, not very much this year. We know it's off into the future before there'll be many changes to auto-enrolment around pensions. So the point at which you are auto-enrolled into a pension remains at £10,000. And then the earnings bands are allied to national insurance, so they don't change at the bottom end, where the lower earnings limit has stayed at £120 a week, £520 a month. At the upper band has gone up slightly because of that increase to 50,270. And the only other noticeable thing around pensions is the freezing of the lifetime allowance. That is significant. It sounds like a huge amount of money, but £1 million pension fund is not a significant amount of money if you're in a final salary or defined benefit scheme. Predominantly those remain to be the case in the public sector in the UK more than anything. But if you have a £50,000 pension entitlement in a final salary scheme, that means you have £1 million pension fund. So it sort of hits the middle income earners, not just the higher earners. And as it's frozen for 5 years, it will drag more people into needing to take lifetime allowance protection, which has an impact on what we do within payroll and not auto-enrolling people anymore. Okay, next one, please. On family-related rates, the statutory payments for the 5 family-related statutory payments, or the S's and P's, go up at Sunday, which is Easter Sunday, the first Sunday at the start of the beginning of the tax year in the UK. It's a tiny increase from an inflation perspective to £151.97 a week. We only quote a daily rate for these because some software splits weeks into chunks that fall over the end of one month and the start of the next. We don't pay daily amounts of these at all. We're fortunate that we're still getting 92% back for most employers. Very few small employers qualify now for the larger recovery rate, but this is the sort of area where you might see the government making some changes in order to get some money back by reducing how much money we can get back for the family related rates, because we've got to pay for all the pandemic support somehow. Okay, next one please. SSP, statutory sick pay, always does change on the first day of the tax year because it is a daily rate. These are the figures that are embedded now in payroll software for the start of the year. There was some mistakes around this in the early days of announcements, but these are the settled figures now, and it does only go up by a tiny amount. So we will have a lot more debates in the UK, I think, about the level of SSP, because there's become such an awareness during the pandemic of how low the value is. But of course it is company sick pay, it's fully funded, apart from the fact we've got some small employers getting some back at the moment, but that's only because of the pandemic. So anything that the government decides to do to increase statutory sick pay is a direct cost to employers. So it's going to be a very interesting debate. Next one please. The big increase concern for employers is what happens with national minimum wage from the first pay period that begins on or after the 1st of April, because this year in the UK the top rate of national minimum wage goes down from age 25 to the 23 and 24-year-olds. So they're getting a very significant uplift of 8 to 9%, whereas the headline rates themselves haven't got enormous uplifts as had been expected, but because we're bringing more people into the headline rate, that's a significant increase for that group. So that needs attention, therefore, to salary sacrifices and also to those who are on maternity, because this is an awarded pay rise for what we call an alabaster recalculation. So it requires employers to have a look at the impact on people's maternity pay. If we can have the next one, please. So, and the next, thank you. Student loans. This is devolution at work here. So in the UK, a number of areas of responsibility are devolved matters, and education is a devolved matter. So each of the 4 countries can make their own decisions about higher education support, and that's what's happened in Scotland this year. The Scottish Government have decided to introduce a new student loan plan, which will be called Plan 4. So that means that the repayers need to be moved out of Plan 1 where they are now and into Plan 4, and that's already taken place in terms of what was issued last week, which were 335,000 instructions to switch people from Plan 1 to Plan 4, with a very generous threshold of 25,000, which means some of them will stop repaying their loans altogether. This is not a matter just for employers in Scotland, it's a matter for employers across the UK, because it's where the employee or the individual at that point was living at the time they took their loan out, which would have been from the Scottish Awards Agency. At the same time last week as the switching from 1s to 4s that was affected by SL1 forms, there were also another 500,000 SL1 forms that were issued, which are the new people who are coming into repayment at the start of this tax year. That's a standard about a number of people that relates to the people who graduated last summer or who dropped out of courses who come into repayment at the start of the next tax year. It means though we've got 3 different undergraduate student loan plans now, and as we can only operate one of them at a time in the payroll, we always have to have this default rule of if the individual indicates they have more than one plan, we always set up in the payroll the one that has the lowest earnings threshold for the year, which sometimes, but not always, will be Plan 1. It really depends what the combination of plan types is. If we could have the next one, please. So these are the thresholds for the new year. So you can see there the Plan 4 sitting in between Plan 1 and Plan 2 at 25,000, and no change to the postgraduates, where the 21,000 threshold has been the same since recovery was introduced a couple of years ago. Next one, please. This is the new starter checklist that's required as a result of the introduction of Plan 4. Everybody should be completing a starter checklist in the UK who's a new employee or deemed employee, and I'll mention what a deemed employee is in a moment. And despite what our government website says, it is not the case that people don't complete this if they have a P45 leaver form from their previous job. Unless everybody completes a starter checklist, they will not be on the correct student loan deduction when they begin. So as a matter of process, everybody should complete one. It's only the reverse of the form that's actually changing from the 6th of April. The front changed in March of last year, and the reverse of the form has got 2 questions about student loans that tries to tease out the combination of plan types that the individual has and gives them some indication of what those might be in the box at the side. Next one, please. So as a result of the student loan plan form changing, it also means that we have to introduce a new P60 at the end of the 21-22 tax year, but we've got one anyway to be given out at the end of May in respect to the tax year that's just ending. That's because in the UK last April, at the start of the tax year, we introduced a new statutory payment, statutory parental bereavement pay, so that necessitates a new P60, and as I say, and yet another one next year. And HMRC, our revenue authorities, do not provide those blank forms anymore. You have to produce them from your software or buy them on a commercial basis. Next one, please. So RTI this year, fortunately, not many changes to real-time information. There's a new marker sitting in software that was first there last April, but now it needs to be used by the private sector as well for deemed employees. I'll have a look at what those are in a moment, as I've mentioned. And then there's this introduction of Plan 4 loan types as well. But the data item guide to how real-time information validations occur for next year is on the link on the screen. Next one, please. The other change to RTI this year is that we've had a transitional move over a couple of years to get rid of a very clunky, didn't work very well way of correcting prior tax years, which was called the earlier year update. It didn't work very well because it was an afterthought when real-time information was designed in 2013. because HMRC had no understanding that payroll professionals might need to correct a prior year. Their belief was that payroll is always perfect when it's submitted. They soon began to realise that that was not the case, because we pay human beings who do unpredictable things. So they introduced this very unfortunate file called the Early Year Update, which has never worked particularly consistently, so it's gone from the start of this tax year, and there's just the ability to send a new year end for somebody. So up to the 19th of April, you've always been able to replace a year end referring to a previous year. From the 20th of April onwards, you can now do that. You still have to indicate it's late, of course, because it should have been submitted by the 19th, but it's a much more secure, robust way of correcting prior year records. So that's really helpful for both employers and employees. Next one, please. Just turning to benefits in kind and this year's P11D forms. I'm afraid a lot of company car drivers will forget and be probably quite angry when it gets to July, when they find that they are paying their full company car charge this year, regardless of whether they've been able to go very far in their company car, because it doesn't matter that the car was locked down unless they return the keys to their employer for at least 30 days. They're paying the full year charge. But there are some company car users who will be on a winning streak. If they're driving a fully electric car, whenever that was registered, no tax this year. The hybrid electric cars, depending on how far they can go on one charge, those can be much more attractive than they were previously. Conversely, the poor folk driving diesels, unless their cars have converted to clean diesel, are paying a lot more tax. They continue to pay 4% addition. It's also important that when we get to P11D time, that you think through if there's been anything that the individuals have enjoyed, if that's the right word, related to COVID-19, that sadly is actually a P11D benefit. Far too many employers in the UK think that we're in the Wild West at the moment and that the tax rules have gone out the window because we've been living through a pandemic. They haven't. So unless HMRC have actually changed something, and there have been a number of easements, but unless you're utilising one of the easements that's announced, nothing has changed. So, for example, providing taxis to work for people who can't use public transport, or you don't want to, is still a benefit in kind. It's normal commuting. So it's either going on their P11D, or, as the revenue keeps saying constantly when we ask them, just put it in the PSA, where automatically all COVID-19 related items are okay this year. Well, that's great for HMRC to say, of course, but it's very expensive just to shove everything into a PAYE settlement agreement, because it costs the employer an awful lot of money. So I think we're going to find some interesting scratching of heads and sighs when finance directors realise quite how much this year's PSA is going to cost. We've been progressively introducing benefits in kind going through the payroll in the UK rather than being reported at year end. There are no changes to that process for the start of the new tax year. There had been an expectation there would be some changes, but the legislation hasn't happened because of resource constraints at HMRC. Next one, please. So there is your company car chart for the P11Ds that are coming through in July of this year. You can see how it is good news at the lowest end of emissions, and it increasingly gets unpleasant at the top end at 37 still for the 170 and above. Next one, please. When we look ahead to next year, you can see that what is happening here in the UK is that we're in a new CO2 emissions regime, and as a result of that, the tax rates are inexorably moving up to reflect the fact that many more cars will have moved into higher bands, because the emissions are now measured over the specific accessories that the car that has been selected for the car, not just its model. So it's going to get more and more expensive to have certain types of car and car accessory over the next few years. Next one, please. Then just wanted a quick word about what we call optional remuneration arrangements in the UK. These are where individuals give up some of their salary and choose a cash benefit, a non-cash benefit instead, or have chosen a non-cash benefit and in so doing have given up a cash amount they could have had instead. Those are called optional remuneration arrangements, and when they were introduced in 2017, there were some of these arrangements for what we might call the more expensive benefits that were given a 4-year transitional window to the new rules, which are potentially much more expensive. So if people moved with pace and signed up to contract changes before the rules came into effect on the 6th of April, they had a final 4-year window to the end of this current tax year where they wouldn't have to move to this new calculation. We are at the end of that transition now. Predominantly, this affects company cars. It does affect some of my clients who've got school fee sacrifices or operas, and some of my clients with living accommodation arrangements, but predominantly it's company cars where this is the issue. So if we have a look at what these two types of arrangements are, and an example of one of those. Thank you. If we could have the next one. So we have two types of optional remuneration arrangements. We have type A, where the individual gives up some of their salary in exchange, for example, let's focus on company cars, for a car that isn't what's really referred to as a green car. So cars that are under 75 grams are classed as green cars, and these rules don't apply to them. But anything that's a non-green car, if you're giving up salary and receiving a car instead, that's a type A arrangement. A type B arrangement is where, whoops, lost my headphones, is where an employee chooses a company car and so doesn't get a car allowance. And this is where the car employer has a policy of either company cars being available or company car allowances. If you choose the car, you're deemed to have given up the allowance. So that's also a sacrificing of an amount of money. So if we have a look at an example of what that means in cash terms. Next one, please. So we've got somebody who chose a car rather than a car allowance of £500 a month, and they signed up for that at the end of March. So it was in force before the 6th of April. Let's assume the car had a list price of £22,000 and emissions of 22%. For the last 4 years, the P11D was calculated on that basis of the list price and the emissions, which you will all be used to if you process UK P11Ds for company cars. But this year, for 21-22, things are different, and we have to find the starting point that's higher of either what has been done for the last few years or the money that's been given up because they didn't take the car allowance. And you can see in that example that the money, 12 lots of £500 a month, would have been £6,000 that the employee would have received. So that becomes the starting point for the P11D, and it then only gets reduced if there's any allowable reductions, as you would have for company cars generally, such as putting down a lump sum or not having the car all year or paying something towards it out of net pay. So you can see that that's what the government wanted to achieve: more tax to be paid by the individual, more Class 1A national insurance by the employer, and so doing dissuading employers from having those sort of choices within their policies because of the impact on the employer and the employee. Next one, please. Off payroll working, just a very, I could obviously spend half a day on this because I do half-day courses on this, so very, very quickly, because I know we only had a few minutes to talk anyway. This is the big status change that's happening at the start of this tax year. It's been in place in the public sector in the UK since 2017, but it rolls out to all but small private sector engagers from the start of the new tax year. And we say engagers because this is a change of status when you are using the services of consultants and contractors for their own personal service, but they're working through an intermediary. So a limited company, I have a limited company that just employs me. That means I'm not self-employed, and sadly the press in the UK have got in a terrible pickle with the difference between being self-employed and employing yourself over the last few months. Not just talking about this rule change, but talking about furlough as well. It might sound like semantics, but there's a big difference between being self-employed and employing yourself. So these rules, which look at the status position, look at those people who do have limited companies between themselves and the people that they're offering services to, which is likely to be, you know, a limited company just employing them or a partnership. It's not a change that affects anybody who is a sole trader. That's what we mean by self-employed in the UK, because there is nobody between this, or no structure between a sole trader and whoever they're doing work for. It is just an individual. They have limited company at the end of their name, for example. So if you are an engager, as in an organisation that uses consultants or contractors, it's your responsibility to take reasonable care to assess the status of these people and think, if I stripped away the limited company or partnership, would this individual look like an employee? And if that's the conclusion you come to, they now have to go onto the payroll so that their invoices and the fees on their invoices can be subjected to tax and national insurance. So their invoices are paid net of tax and national insurance, and they're reported under RTI as if they were employees, but they're called deemed employees because all that's happening to them is that withholding of tax and NI. We're not giving them any employment rights. And we tell HMRC that they're deemed employees because we set this marker called the off-payroll worker marker. It would be useful if consistently they weren't called either deemed employees or off-payroll workers, but the revenue interchangeably uses the words to mean the same thing. If you're not on top of this yet, really the best place to go is the ESM, which stands for the Employment Status Manual. It's HMRC's internal procedure manual, and it's got all the information about off-payroll working. Next one, please. So if we have a look just pictorially at what this means to try and just reinforce it, unless you're small in the private sector, for which many of my clients are glad to find that they are small, because that means they can use their consultants and still pay their invoices gross. What happens from the 6th of April for work that's completed from the 6th of April onwards is the consultant continues to invoice the client, but the client will have agreed with them when they're agreeing the contract at the outset whether this role is a role that's caught by the off-payroll rules. If that's the case, the consultant will receive a status determination statement confirming that, and will therefore understand that when they invoice the client, they won't have their invoice paid gross anymore. They'll receive the fees, net of tax and NI, and only the VAT and any allowable expenses, which won't be the same expenses as they might have had historically as a consultant. That's what will be paid into the consultant's company bank account. The client will set the individual up on the payroll, or the agency, if it's the agency who is paying the consultant's invoice, somebody has to set the individual up then. So extracting the individual from their company, so in my case, setting up Kate Upcraft on the payroll so that I can be reported under RTI, but paying my invoice to Kate Upcraft Limited. So HMRC sees me appear as a deemed employee of my client, but I continue to run my limited company and the money still comes into my limited company, but not as much as it would have done before. Next one, please. So it's all about setting the payroll up and process change. Your software doesn't need to change to accommodate deemed employees. They can be handled from a software perspective the same as anybody else, but it is vital that these deemed employees complete a starter checklist. You therefore capture all the skeleton RTI data you need, including, please, their residential address, not their company's business address, because HMRC needs to decide from a devolution perspective whether they're Scottish or Welsh taxpayers, which wouldn't be obvious if they use, for instance, their accountant's address as their business address. You need to allocate them a start date, even though they're not earning service with you, in order to set up the records. That'll either be the 6th of April if they've already been working with you, or the date of the start of the contract. You'll agree their national insurance table letter for social security purposes and their tax code, just as you would for any new starter, and make sure the consultant understands what that's going to mean. And then your payroll software, really it's a conversation what it's going to do, or how much you've got to intervene to make sure these deemed employees do not have the national insurance that is being paid on their invoiced fees, which is employer and employee NI, that employer NI is not recovered from HMRC under the employment allowance exemption. It's not an allowable recovery, and that the individual doesn't get any pension rights, any sick pay, holiday pay, and is not included in gender pay gap reporting, because although these are people who are being added to RTI, they're not full employees from an employment rights perspective, so they don't get any of the good obligations, they just get to pay tax and NI. None of the documents that you would normally produce for an actual employee are legally required to be given to a deemed employee, such as a pay slip, a P45 or a P60, but it's sensible to provide them as your software is going to generate them anyway. So there's transparency for the consultant as to what's actually been deducted from them during the length of the contract. When the contract is over, they have to be resigned. That's obviously in inverted commas because they're not really resigned, but they have to be removed from the payroll, and the only way to do that is to put an end date in. So make sure that payroll get to know when the contract is over. If they make it to the end of the tax year, they have to have a P60 as all other employees would have, or at least you will generate one, which sensibly you would want to give to them. Next one, please. So if you don't do this correctly in terms of this change of legislation, it's a very expensive risk to take, because as well as standard PAYE penalties that HMRC can levy after the first 12 months of the reforms, the other huge sword of Damocles is what we call transfer of liability. So if you fail to take reasonable care with any part of this new legislation, then the business, as in you as the engager, risks being asked by HMRC to pick up the consultant's tax and NI, as well as your own employer NI and apprenticeship levy. And that's been done deliberately to make sure that both engagers take seriously this change in the law, but they also secure their supply chain and make sure that all the agencies they're working with also act appropriately if they're instructed to deduct tax and NI from a consultant's invoice. If we could just see the next one, I think is the end. So I know that was quick. I was only asked to give you a quick overview, but hopefully it's given you a flavour of what's going on in the UK at the moment.
That's fantastic. Sorry, Kate, we found your email in spam.
Oh dear.
I'm sorry to add pressure to you by not having that ready, so apologies.
No worries.
But thank you so much for showing or to present to us today. We do have a question. Okay, so if you have a flex spend scheme where the employee can choose medical cover or a cash benefit, does Opera apply, or is it just company cars?
They can choose medical benefit so if they don't choose their medical insurance, to use medical insurance, they get more money. Is that I presume what the individual's saying? That is an Opera situation, but it didn't get the transitional protection anyway, so you would have been doing this new P11D calculation for the last 4 years, or you should have done.
Okay, thank you. And does anybody else have any other questions at all? You can, if you do have any questions, you can raise your hand. So I'm going to hand this over to Kevin. So this is all to do with our new software. Hold on a moment, I'm going to pass it over to Kevin. There you go, Kevin's up on the screen now.
Hello.
Hello, Kevin, we can hear you.
Cool. Yeah, I can't see myself. It's a bit strange. Where's my camera gone? Oh, there we are.
There you go.
Hello. It's kind of just a different kind of question, but what would you say to yourself last year, now, after the year that we've had, just as a bit of a curveball?
Sorry, what did I say to myself in what respect? What do you mean?
Well, if you knew what you knew now, what would you say to yourself like 12 months ago before we started this beautiful journey?
I should have retired last March. Seriously, I didn't expect to even be in business this time this year, because all my work fell apart on the 17th of March last year. I had no expectation we'd be able to do any work online. It was just a complete unknown quantity of what on earth would happen. So it's been really bonkers. And as it happened, I've certainly done more hours in the last year than I have in the previous years. I've not had a day off now for a year, and a lot of it has been quite rightly just helping people, not for any chargeable reason, just to try and help people through all of this. I think what's been so interesting is the ways that people find to get hold of you. At any one time, you can be dealing with WhatsApps, LinkedIn messages, text messages, emails, phone calls, because people are desperate. Yeah. People are desperate to try and find the answers to do the right thing for their employees. I know the government would say, and they're right, that there's been a lot of fraud, but there's also been an awful lot of employers just trying to do the right thing and stay afloat. and a terrified feeling of, have I done it wrong? And this next 6 years of HMRC coming after them if they've done something wrong. So yes, it's been great for payroll professionals in terms of profile. The pressure has been intolerable, and I don't think that we can afford to let us slip backwards into where we were before. We've got to keep that profile up and the understanding that businesses would not have survived without the teams doing what they're doing over the last year. I think it's also brought home to a lot of businesses the risks they have taken having one person doing the payroll, because an awful lot of people are so fortunate that their payroll professional has not got COVID and has managed to keep paying people. Because the amount of people you come across where they are the only person running the payroll from home, just trying to do everything, I hope that's made people value, but also think, gosh, we can't ever let this risk happen like this again.
Yeah, very well. Thanks, Kevin. I'm going to withdraw you now. Does anybody else have any other questions at all, or would anybody else like to join Kate up on the screen while we're here, while I'm trying out my new bit of technology? We've got a lot of people agreeing with you, so I do agree with you. I think it's been an amazing year for payroll people, but a hell of a lot of stress, and it has definitely opened company directors' eyes up about the value of the payroll department, I think, hasn't it?
Yeah, I've had questions from people who would not normally pass the time of day with me as a payroll specialist, because it suddenly dawned on them that they don't understand anything about payroll. And to be honest, this was not a payroll job. This was the claiming of a government grant, but it was just the assumption that because it was to do with people's wages, that all the payroll teams would just step up and be the person that would calculate pay, claim, etc., without any extra resource necessarily or time to do that. So, yeah, bit of an interesting one, really.
Yes, I definitely think we will be talking about 2020 quite a lot, won't we? So
Yeah.
we were lucky to sort of have our conference at March last year, and I think we all knew then it was going to be the last time we were going to see each other for a long time, but maybe not as long as what it has been. So before we end this session, thanks so much, Kate, because I'm so sorry, because I know you've got so much on your plate at the moment.
It's all right. I just feel bad that I didn't know how to make it work.
No, that's fine. It's my fault, and we'll go through it before the conference. So, what we'll do is we'll head over back to the lounge. So, guys, if you need to carry on with your work, but we'll open up the lounge so you guys can network with each other. Love to have some feedback from you about what you thought about this technology, the session. I'll send out a survey to see what other countries you want to get involved. You would like us to get speakers for, and also any other sort of benefits that you guys are looking for. Just to also let you know, we're recording these sessions and they will go up on the portal, so you will see another sort of section on the portal with about GPA updates, so you will be able to watch this again. But thank you, and thanks again, Kate. Thanks, Hayley, for your help as well.
Thank you for your help, ladies. Sorry.
No, it's fantastic. And we'll head over to the lounge. So hope to see some of you guys there.